Hello everyone. Today we're discussing an important shift in India's financial system, the move from a bank-centric model to a corporate bond-based finance model. India's financial system has traditionally relied heavily on banks to fund businesses. But now, policymakers and economists are pushing for a strong corporate bond market as a complementary source of finance. In this video, we'll explain what this means, why the shift is happening, recent developments, and what it could mean for India's economy. A bank-centric financial system is one where the majority of corporate funding comes from loans provided by commercial banks. In India, banks have traditionally been the main source of credit for companies, especially for infrastructure, industry, and manufacturing projects. This system works well when banks are strong, have healthy balance sheets, and can lend efficiently. However, it can also create constraints, especially when banks are burdened with non-performing assets, NPAs, and capital adequacy challenges. A corporate bond is a type of debt security issued by a company to raise capital. Investors, including pension funds, mutual funds, and retail investors, buy these bonds. In return, the company pays interest over a fixed period and returns the principal at maturity. Unlike bank loans, corporate bonds tap into capital markets, giving companies access to a broader source of funds. This shift is happening because of several reasons. Number one, diversification of finance. Relying too much on banks creates risk if banks are weak. Bond markets give an alternative source of funding. Number two, longer tenors and lower cost. Corporate bonds often offer longer term finance at competitive rates, which is attractive for infrastructure and capital intensive projects. Number three, deepening capital markets. A vibrant bond market increases overall financial depth and resilience, attracting domestic and global investors. Number four, international best practices. Many developed economies like US, Japan, and European countries use bond markets extensively, especially for infrastructure financing. Recently, Indian financial authorities and regulators have taken steps to build corporate bond market. SEBI, Securities and Exchange Board of India, has eased issuance norms to make it easier for companies to raise funds through bonds. Regulatory reforms like faster approval, reduced compliance costs, and better disclosure rules are being introduced. The government has also encouraged the development of benchmark yield curves which help price bonds accurately and improve investor confidence. Despite progress, there are some challenges. Limited investor participation. Many individual investors still prefer traditional bank deposits over corporate bonds due to perceived safety. Credit risk. Investors need reliable credit rating information. Poor rating or lack of transparency can deter investors. Liquidity concerns. Secondary trading in some corporate bonds is limited, reducing market liquidity. Experts say that stronger risk mitigation mechanisms, better credit disclosure, and broader investor education will be key to overcoming these hurdles. This transition from bank-centric to bond-based finance matters because it can support India's ambitious growth targets by providing more and diversified funds for infrastructure and industry, help reduce the pressure on banks to fund large projects, allowing them to focus on lending to MSMEs and households, encourage the development of deep, liquid capital markets, which are essential for economic stability and growth. To summarize, India's financial sector is evolving from relying mostly on bank loans to embracing corporate bond markets as a major financing option. This shift is driven by the need for diversified funding sources, deep capital markets, and sustainable long-term financing. While challenges remain, ongoing reforms could unlock significant economic benefits. If you found this explanation helpful, please like and share. Comment below what other financial sector topics should we cover next. Arambagh Pathshala.